Let's talk about the economy a little bit and real estate and what's going on. I'm just out taking a beautiful walk in Bloomington, Minnesota, eating my salad and drinking water. Good habits. Got to do good habits, as well as putting out some content here for everybody. So, what I've been following, and some of this will get a little bit technical, but looks like the yield curve. This is not investment advice. Seek, financial advice from whoever you need to. But the inverted yield curve is coming up, and not an expert in the bonds or anything like that, but what we're seeing is the 30-year bonds are seeing the yields drop, and the Fed rate is going to keep raising to stave off inflation, and we're getting something other than inflation with the actual tariffs now. That's going to heat up and get really interesting, I think. But I've read a decent article on Zero Hedge that said that definitely is, you got to treat it differently than inflation. So because we have the inflation, because we have the bond yields long-term going down, it's priced into the market as far as what people think about the economy long-term. I think it's fair to say that with the quantitative easing of 10 years and quantitative tightening coming up now, that we're going to see a reversal of all this easy credit and easy money for the last 10 years. And if this inverted yield curve happens, what is going to happen from my understanding is the arbitrage that the banks make, it's just not really, it's just not really worth it so much for them anymore. So the lending doesn't make the same amount of sense. So why would they lend that money long term when the money makes less money with more risk long term in the economy versus short term? So you could see a credit contraction at that point if the inverted yield curve comes. It did come in December 2005. Hey Johnny boy, good to see you. And we could see the yield curve invert again right around this year, December of 2018. So if we do see the yield curve invert, if it's like 2005, it followed with the credit contraction, which eventually created more inventory, bank liquidity issues, and then we ended up, totally enjoying the sun. You know, we're off on weather here in Minnesota, and some of these days we've been having some 98, 99 degree days, which is not very typical in Minnesota. And then yesterday was like 70 and windy and rainy. So you just never know. I mean, this is actually one of the more normal days that we've been looking for. So if we see the credit contraction, what ends up happening is you usually feel it across the markets, even globally, and then what ends up happening is, it's harder for people to get loans on homes. It's not the easy credit like it is now with the 50% debt to income ratio and the 1% down payment. So what we end up seeing is more inventory, and then you'll start to see that priced into the market as well, because it will be a supply and demand issue at that point, and sellers will need to drop their prices. So if you want to call that a deflationary market, you can, I guess, but we're going to see, and we could also see stock prices going down as well. What's interesting is an article on CNBC that I just went through about an hour ago, and it basically said the only thing keeping the stock market up right now is the trillions of dollars that these companies have. Maybe a lot of them are tech companies, and they're just buying back their stock. As I said, because there's other articles from a couple days ago. Yeah, Johnny, I'm trying to, at least. I'm not a macro expert by any stretch, but I do follow Jim Rickards a little bit. My brother and my friend Jason do a lot more than I do. And I have been kind of following Peter Schiff off and on for about 10 years. And I do enjoy high level information. I enjoy the narrative of what's going on, because everybody has a different opinion, but it's you got to kind of see which one is going to play out the correct way. So I like the macro markets to that extent. We start talking about yields and bonds and SDRs and IMF and all that. It gets a little boring to me, to be honest, but I stick a little bit more with real estate and housing. But the reason is I just want to understand that ahead of time so you can kind of see what's coming up in the future as far as credit contraction and all that. Yeah, Peter's pretty negative towards the economy. I was watching him. I actually just pulled up an old clip from 2007, in August of 2007 when he was on CNBC, and nobody believed him. He's like, no, this is going to happen. This is going to happen. The housing crash thing, I think I would look more a couple years out as the credit contraction comes on. I don't think it's going to be an instant thing. But, yeah, Peter's second generation, too, from his dad, who wasn't big on IRS and taxes and stuff. So he's second generation of all that. But, yeah, I mean, you could say that he's got a negative spin and stuff. But what he's negative about a lot of the way things are handled. He's negative about how we print all this different money and how we have this illusionary wealth and all this stuff. So that's the kind of stuff when you get to other narratives, you go to websites like zerohedge.com and stuff. Sure, some of them are doomsday and stuff, but you got to kind of follow them too and just see what their perspective is, because there's definitely a wealth inequality that's happening, and there's definitely some things about the future to think about as far as, pensions. Are they going to be there? Are these cities and states going to be insolvent? What are tariffs going to cause in the future? All this kind of stuff. So, 30-year bond. It's a good question. I was following that with one of my friends who's been around real estate for about 23 years. And we were kind of looking if it went up over 3, which it did. They said that was going to be really bad. But now it looks like it's actually, the narrative is that it's actually going down, which is, I think, has more to do with the supply and demand. Russians just sold off like 50 billion in treasuries. And again, I don't really get that much into this subject, but what's interesting is the inverted yield curve. If you Google that, that's the part that's interesting, because some people say it's preceded or predicted the last, it's predicted the last 7 to 9 recessions. Like every time, and so then it goes. I'm trying to remember the exact numbers here. It says between 6 and 24 months after the inverted yield curve, we see a recession on average, and it's caused the last 7 to 9. One said there was false positive, another one said it was flat. It wasn't completely inverted, if you want to get really technical. But this goes back to after World War II. This goes back to 1960. If you want to get even more specific with numbers and stats, if you guys like that stuff. The global yield curve actually just inverted, I believe on June 20th. That actually did just invert. And then they said what's usually the one to invert first is the 7 and 10 year, meaning that the 7-year rate would go higher than the 10-year rate, meaning that you'd make more money short term with your money than long term, which doesn't make any sense, right? And that's why there's a problem in the market and why it could be an issue with banks wanting to send money. So the 7 to 10 year one, they said that would probably invert first, and then they said within 6 to 28 days you'd start to see some of the other ones invert, like the 5 year and so forth. I believe it's the 2 year and the 10 year, or the 3 month and 10 year yields that actually have preceded the recessions, not the 7 and 10, but the 3 month and 10 year, or the 2 year and 10 year. When that happens, that's when we know the recession's coming. It's pretty much always been true. What is the difference between priest and yeah, that's a pretty bad joke. Those priests are bad. Oh, a lot of them, huh? How do you analyze different stocks? What indicator do you look at for taking market position? I don't really analyze the stocks that much. I listen to a couple of my friends that are in the stock market. I had fun in the stock market 20 years ago. The stuff just moves up and down too much for me. I like more long-term plays. I mean, the real estate market's already an 8 to 10 year cycle, but I would prefer even longer cycles than that. And I think you can figure out the disruption on marketing. I think that's actually the key. Yeah, the ratios and key indicators, I haven't. I'm definitely not an expert in that. I mean, 20 years ago, I used to just wait until stocks went up 25% in one day, and then I did a short on them the next day, and that usually won. I remember doing that on eBay. I remember doing it with another stock or two, and it usually was right. Usually corrected itself 10% or 12% the next day. Yeah, I'm mostly into real estate and real estate investing. I was pretty much right on April of 2007. when they're getting rid of stated loans to know that the market was going to crash. So I was going to sell my houses, and I think I got a good year and a half jump start over most people I know. So this time around, I wanted to follow the macroeconomy a little bit more, just to kind of understand, because what I could tell was that the credit standards were getting really tough with loans, and I knew all the people in the business. So I knew when we saw that, and I knew what was coming. It was just to be like, yeah, these loans are going to get to be too tough for buyers. But, now I was just looking at the other day with the whole yield curve inverse thing, and I'm like, they were talking about in the summer of 2005. I remember builders having issues then, and then December of 2005, they said, hey, this is, it actually inverted. I did own a bunch. I owned a handful of them. I got out, like I was saying, in 2007. That's when I had to get out. And I got out of the last one in 2008. And so I was like, well, this is just mimicking 2005 all over again, except there's low inventory. So because there's low inventory, the market's still a lot stronger. But yeah, it's this time around, I just want to be a little bit more ahead of the game, because I was there when the builders were running into credit issues with the buyers, and they had too much inventory there 3 years before the mainstream. Because Lehman Brothers is when most people think of the crash. It was like September of 2008. But it's like, geez, we knew about that over 3 years ahead of time. So what I'm trying to do is stay a little bit more ahead of it now, and try to see what's preceding the actual credit contraction before it really hits real estate, so that we can talk about it on here and kind of know that we're talking about it way before it happened, right? It's that way it's more believable, because when you see people like Peter Schiff on CNBC, it's like nobody would believe him, like literally like just 3 to 6 months before some of that stuff happened. No houses now. No, I sold them off. They didn't feel liquid enough for me, to be honest. They were just a little tough to move when the market turns. I will say, if I were to do it all over again, though, I'd definitely make sure you got $500 to $600 a month in cash flow coming in on each property. That's the way to do it. Otherwise, there's not enough incentive to really own the houses. So